But just a few more seconds. Let's see.
These impacts from default student loan borrowers. And so really suddenly credit scores are going to look a lot worse. And your borrowers and consumer will no longer be able to access credit when they need it the most because they are so burdened under their debt.
Yikes. Okay, so that's pretty bleak. It's already bad. Basically, DTI, debt to income ratio. Basically, what is a percentage of how much money that you owe versus how much money that you're bringing in? That's your debt to income ratio, right? This is an indicator that every every lender uses, whether it's you're financing a car, you're getting a mortgage, everyone looks at your DTI. So now that it's peaking, but buy now, pay later isn't really figured into DTI in the past. It is now. So that
More
DTI,
so it will affect your DTI with the buy now, pay later. But if it's marked, I don't know how it's marked on the credit report, but it should be like an installment loan. So if it's an installment less than 12 payments, it's not going to affect your DTI. It's going to affect how recent the line was open and how much
Okay.
you owe. Like what's the utilization level, right? Is it like high utilization and new recently account open? Then yeah, those things can ding your score.
Right. I think the point that Melody is making is that people who are already in the homes are doing the buy now, pay later with their groceries, and that might all come into the picture very, very
But
soon.
it 100% does, because I am seeing that too. Like I have clients I talk to on a daily basis, or like potential customers that inquire and ask for help, right? And I see it. Like I see their debt levels. It's really high. It's
Yep.
they originally, when they bought a home, they had a budget in mind, right? They were comfortable with that payment. And then lifestyle or lives change when you have kids, growing family needs, and you can't prepare for that budget unless you're thinking ahead. I mean, just to segue off what you were saying before, like before we jump into the whole DTI thing that you're talking about, I mean, like FHA loans, it's like we knew the borrower was risky. We knew the guidelines would let you go up to 50, 55% in some cases, as long as there were compensating factors at the time.
That's the thing I want to ask you about, because they don't talk about that. They make it seem like 43 is a hard line, and once they cross that 43 percentage, they've like broken the law or something, or like
Even conventional loans, you can go up to 50.49% on a Freddie Mac loan through their desktop, like a loan prospector on their desktop underwriting system, right?
Yeah.
But
So
you got to remember
what are
too,
the
just because
additional
the
factors?
AUS says you can do it doesn't mean you can get it, because the underwriter has to sign off on the income. So
Yes.
and you got to get this too. Even if it works and the underwriter committed fraud, because what they're saying is fraud, right?
Basically,
That
they're not
becomes
saying
an
the word, but
impaired asset, which means Fannie and Freddie will come back to the lender and broker and say, "Hey, you need to buy this back because this was a poorly written loan that we can't buy off of you." And now it's in our industry, it's called an impaired asset. So to me, it's like and that was a big part of the business, like fixing impaired assets at large direct lenders. So it's like I don't understand like how maybe
well, they're not even saying that. They're actually
yeah.
saying that Fannie and Freddie and FHA are the ones pushing for lenders to lend out. So they're saying the government is behind this bubble.
I don't know, man.
And I think I mean, I
When they
could be
look at
totally
numbers all
off.
day on the back office, then maybe then in that little tunnel vision that they have over there, because my tunnel vision says it's damn hard to fund somebody at 65% debt to income on a VA loan. Like I've seen it. I've seen one of my team members, I think back in the day, like we saw one go through at like 66 or 67% on a VA loan. Debt to
But
income.
they had other things that
They had other
boosted,
compensating
right?
factors. They met residual income requirements. They checked off all the boxes and it still worked, right? But that again, what was the purpose of getting that person into that house or refinancing that person to put them in a better position, right? So it's like, and what about the other fact? Think about it this way: FHA and VA, you can streamline. regardless of debt to income ratio. So it's like, as long as tangible benefit is there, because A, the monthly payment reduces by a minimum required amount, or B, the interest rate drops by 0.5% and there's benefit, your debt to income doesn't matter at all on an FHA or VA streamline, as long as the savings are there. So that program like was designed to help people get into homes. So it's like when they take that point and say FHA whatever, or FHA defaults are going to be at an all-time high, of like, to me it's like, of course, like
the delinquencies are going to be,
the program. They're like, we want you to lend to riskier, what you would say look as a lender would look at as a riskier borrower. That's
right. The private sector doesn't want to do it, but the government says we need this to get done, and we'll
otherwise they can't get into
incentivize
home,
you,
or we can't keep them in their home, right?
Right.
So it's like,
okay,
come on. Who are you trying to scare?
I love it. Well, I don't know. People that aren't in the industry, I guess. So, okay, I'm gonna skip over to, for anyone who wants to watch the full episode, I'll link it. I'll link it in the show notes. Shout out to Real Estate Mindset. I think they produce good content. I just wanted to throw in our voice and give people a more rounded perspective, because this is if you just watch this, you're like, I was honestly a little bit depressed. I was like, this sucks. We're headed for like deep recession. But then I thought about it more. I was like, no, I think, yeah. Anyway, let's
go on, explain your train of thought, because you're the audience, right? You're 100% the audience on that one.
I'm newer into this field. I did my licensing. I did all the the coursework and everything. So I know the facts. I know technically like what they're talking about. It makes sense, but you're the one with the experience. So we've been going through discussions on a regular basis, and what I've learned from you is that there's always so many sides to this industry and so many perspectives. It's like the elephant in the dark cave, right? Like everyone's touching a part of the elephant, but no one really sees a huge clear picture.
Interesting.
And like for viewers, you watch one YouTuber say something like this, that it's very fear mongering, not accusing Real Estate Mindset of being fear mongers, but it is a little bit fear inducing, and that does drive clicks. But there are also people like us who want to just kind of bring a balanced approach and say, okay, yes, that is the data, but here's some other anecdotal data that we're seeing and that you might want to consider as well.